So this question is called Kesare, and part A asks us to talk about the conceptual basis for deferred tax. If you're short of ideas, go to the framework. Per the framework, information in financial statements should have two key characteristics. It should have relevance, should be relevant, and it should have faithful representation. Deferred tax is the tax on a temporary difference. A temporary difference is created through timing differences between accounting for items in the income statement and the tax computation. So, am I answering the question? Well, I'm sort of giving you both strands. I'm giving you sort of, well, where do all the concepts come from? That comes from the framework. We're now looking at the specifics of deferred tax. Deferred tax liabilities do represent faithful presentation or representation because they relate to future tax payments that are probable. Therefore, we have greater completeness because what we're doing is we're showing the tax consequences of a past event. And we also have greater prudence. It can be argued, or we also say that the relevance criteria is also met because historic transactions impact upon future cash flows. And one of the things that shareholders and other investors want to know is, what are future cash flows? Because one of the ways of valuing a company is to value its future cash flows, its future income, its future expenses, and so on. The main criticism of deferred tax is that it does not necessarily satisfy the definition of a liability per the framework. This is because the payment of tax only arises if future tax legislation exists. And in theory, a liability arises from a past event. But we're saying that this tax liability is going to occur in 3 years' time, assuming that the tax rules have not changed. Well, as we all know, tax rules change every single year. But my view is that on balance, we should be showing deferred tax. And you can talk about things such as consistency. Do you know the effective tax rate calculation, which is tax divided by profit before tax? Well, deferred tax helps to keep that broadly, keeps it much more constant. So it reduces volatility in the financial statement. So you could put that in as well. So there's many other things that you can put in, but I'm looking at this question, and this question is saying 7 marks, and I've got roughly 7 points. And at the back of your mind, have that thought at all times. Part B is the deferred tax liability and the adjustments. Okay, it says assume any adjustments do not affect current tax. Candidates should briefly discuss the adjustments required to calculate the deferred tax liability. So we're given here a statement of financial position. Now, I think in the model answer, they've provided you in the answer with a statement of financial position. In my opinion, that was not part of the requirements. So I wouldn't have prepared one. In fact, I'm not going to prepare one because it's not part of the requirements. Let's deal with items, item by item, bit by bit, date by date. So we start off with financial assets. These are investments in equity instruments. So per IFRS 9, these should be measured at fair value. Now, in the balance sheet, in our statement of financial position, we're showing them at cost. So what we should do here is we should debit financial asset, and we're told that the market value is 10.5 million. So we should debit financial asset 1.5 million and credit, it says, as allowed by IFRS 9, an irrevocable election was made for changes to go through OCI. So I'm going to credit OCI 1.5 million. So that deals with the accounting. Next, let's deal with the deferred tax. Step 1 is we say, well, what is the carrying amount? Well, the value in the SFP is now 10.5 million. Taxation is payable on the sale of the assets. So what is our tax base? It is the cost of 9 million. Therefore, we have a taxable difference of 1.5 million. We're told in the question that the tax rate is 30%. So our deferred tax is 30% times 1.5 million. It's 450,000. So we credit deferred tax liability 450,000. What should we debit? OCI. Why OCI? Because of the consistency principle. If the gain is taken to OCI, the tax on the gain should be charged to OCI. So that's 450 like so. So that's item number 1. Item number 2 is the bond. The stated interest for long-term borrowing is 8%. The loan of 10 million represents a convertible bond, which is a liability of 9.6 and an equity element of 0.4 million. The bond should be separated into liability and equity. Therefore, we're going to debit the bond 0.4 million and credit equity 0.4 million. This is in accordance with IAS 32. It's the logical thing to do. If we now look at the deferred tax on the bond, what's the carrying amount of our liability? The carrying amount is 9.6 million. What's the tax base? That's probably other reserves. What's the tax base? It's 10. So I've got 400 negative, but it's 400 negative on a liability. So this is a taxable temporary difference. If it's a negative on an asset, it's a liability. If it's a negative on a liability, it's a deferred tax asset. So therefore our deferred tax asset is 400 times 30%, it's 120. So we debit deferred tax asset 120 and credit equity other reserves 120. Notice what we did before. So that's taxable, so that's a deferred tax liability, sorry. So we're going to credit deferred tax liability. So I've got to mix that one up. It is so easy to mix these up. Thought that looked wrong. The pension. It says the defined benefit plan had a rule change on the 1st July X5, giving rise to past service costs of 520k. The past service costs should be recognised immediately per IAS. So we would debit the income statement 520, and what would you credit? You would credit your pension liability. If we now take a look at the deferred tax, our carrying amount, if we go to non-current liabilities, can you see that our carrying amount, it was 4 million, but we've just increased that by 520. So our carrying amount is 4,520. And if you take a look at note 4, the tax base here, the examiner has given us the tax base, it's 5 million. Okay, so look at note 4. It's hidden rather nastily below, because I was looking at that for ages. So here we've got a negative figure of 480. This is a taxable temporary difference because we're dealing with a liability. So therefore what we're going to do is we're going to say that our deferred tax liability is 480 times 30%, which is 144. So we credit deferred tax liability 144, and we debit the income statement 144. We then have the other assets. And here we're given our tax values. So all I'm going to do is I'm going to create for us a table. So we've got PPE. For PPE, our carrying amount is 10 million. And per note 4, our tax base is only 2.4 million. Trade receivables, our carrying amount is 7 million and our tax base is 7.5. So this might be because the tax authorities have been stricter on receivables allowances. Other receivables, carrying amount 4.6 and tax base 5 million. So if we work out our totals, I've got 17, I've got a carrying amount in total of 21.6 million. A tax base of 14.9. So we have a taxable temporary difference of 6.7 million. The deferred tax liability on that £6.7 million times 30%. 2010. All of these items are income statement items, so it would be debit income statement 2010, credit deferred tax liability 2010. Then we've got note 2. Other intangible assets were development costs which were all allowed for tax purposes when the cost was incurred in 20x5. So we go to development costs. The capitalization of development costs is the correct treatment per IFRS. So that gives us a figure of 5 million. So we can say that our carrying amount is 5 million. What's the tax base? Well, it says in the question the development costs were all allowed for tax purposes when the cost was incurred in 20x5. So what are the tax authorities carrying forwards? Nil. Nada. Nothing. Niet. Sorry? Noida. Noi. No. Even. Anybody? Anything else? Any more? So our taxable difference is 5 million. So our deferred tax liability is going to be 5 million times 30%. It's 1.5 million. So we would debit the income statement, 1.5 million. And credit deferred tax liability, 1.5 million. Next, we've got trade and other payables. And it says trade and other payables include an accrual for compensation to be paid to employees. This amounts to $1 million and is allowed for taxation when paid. It is correct to accrue for employee compensation if a contractual obligation exists, if we look at the tax, our carrying amount, what are we doing? Well, we're carrying forward a liability of $1 million. What's the tax base? 0, because we're carrying, the tax authority has said you've not physically paid out an expense, and we're not giving you an allowance, so we're not carrying anything forwards. So we've got a figure of 1,000, but because this relates to a liability, this is a deductible difference. So our deferred tax asset, it's 1,000 times 30%. It's 300. So we debit deferred tax asset 300 and we credit the income statement 300. We then come to goodwill. Goodwill is not allowed for tax purposes. Goodwill is an example of a permanent difference because it is never allowed as a tax expense. There are no deferred tax tax consequences. So that is how to approach a big deferred tax question, but it's not just a deferred tax question, is it? It's testing your accounting knowledge of a number of topics. So the reason why deferred tax is quite nice to examine is because it's testing you twice. Do you know the accounting? Do you know the deferred tax?